Hello, with me today I have Sven Borho, co-manager of the Worldwide Healthcare Trust. First of all, Sven, happy birthday to the Trust, which is 25 years old this year. Your investment approach, which is very much about identifying sources of outperformance with a focus on fundamental research, it served you well in that time. Do you explain to viewers how you do it and what the sources might be?
Well, first of all, thank you so much for mentioning our birthday. The trust was founded in April 1995, and it's been quite a wonderful ride here for the past 25 years. We are obviously very proud of our investment record over this period. Healthcare in general has been a terrific sector, beating the broader sector average by a large margin. We have been able to significantly outperform our very, very strong benchmark during that period. The key sources for our outperformance is really fourfold. So number one, it's our truly worldwide approach to healthcare investing. This is where we find a lot of the dislocations, a lot of market inefficiencies, and this is a key driver for the trust. Our headquarters are in New York, but we have 11 locations worldwide in San Francisco, in Mumbai, Shanghai, and Hong Kong. We always like to open offices to geographic areas where we see a lot of innovation and a lot of growth. So this is a very, very important contributor to performance. Number two contributor is that we can invest in every single part of the capital structure of healthcare companies, and we invest in every single subsector inside healthcare. So we are not a one-trick pony where we are just dependent on one subsector, like, for example, biotechnology. We can move in between the subsectors, and that's another key contributor. The third is that we are VC investors in the healthcare space. We have an in-house ability to invest from a university startup all the way to Pfizer, Merck, and Amgen, to the very, very largest market caps in our sector. We never get surprised by innovation coming from the private companies. And that's another key thing. We are always on top of all the investment, all the innovation, both on the public and the private equity side. Our most important, actually, competitive advantage is the size of the investment team. And I always like to compare that to an arms race. And I know this is an arms race that OrbiMed is winning. We have 100 people dedicated to finding the best investment opportunity anywhere in the world. We have 30 PhDs, MDs on our staff, and we have 15 ex-CEOs and founders of healthcare companies on our staff. And this is the arms race that OrbiMed is for sure winning. And this has been the key recipe for the outperformance for the past 25 years. And I'm quite confident that actually this recipe for success is still very much in place for the coming 25 years.
Well, Sven, you talk about the fund's impressive history of outperforming its benchmark. It's also in positive territory for 2020. Is there anything specific that during the sort of 2020 so far that's triggered outperformance?
Our style of not too heavily invest in the large mega cap companies, but invest more in the small and medium-sized companies, very innovative companies, and fast-growing companies in our sector. And this is especially true in biotech, medtech, in emerging market subsectors. Now, the last fiscal year is a very good example for that. Our fiscal year runs from March 31st to March 31st. The two subsectors that really drove the performance during that period were emerging market names in China and small cap, unprofitable biotechnology companies. So key drivers were Arcul and Decipher on the biotechnology side, CanSino and Hanso in emerging market names. But other very important winners were as well in other subsectors. So, for example, Dexcom in medtech, super fast growing company in that space, Natera in tools and diagnostics, and eHealth in services. So our winners did not come from the large cap space like the large cap pharma companies. Now, you mentioned already we had a terrific start into our new fiscal year. So this is really the period since March 31st till June 30. We had an incredible snapback there from the severe overall market pullback in March. So we are up actually in that first quarter of our new financial year, up 25% with 10.8% alpha over our benchmark. And similar to our last fiscal year, emerging biotech names and emerging market names, they have been the key contributors here in this market snapback. We generated more than 800 basis points in emerging biotech names, in 800 basis points in emerging market names. Some of the key stock highlights were IPO of a Chinese diagnostics company, Burning Rock, Natera, another diagnostics company here in the United States, Mirati, oncology company in the United States, and the spec pharma company called Horizon Pharmaceuticals. We had as well two large cap winners here in our first quarter. So Takeda in Japan and Alexion, a big large cap of the biotechnology companies, were important contributors as well.
Okay, well, I mean, geographically, North America is the main focus, or has been the main focus for the trust. But I mean, I wonder whether you can tell us a little bit about your investments, a bit more about your investments in emerging markets. And you mentioned China and one of the IPOs there, but there have been quite a few, and you've been active in China recently. I just wonder whether you could tell us a bit about your activity there.
Yeah, absolutely. Well, we are convinced that Asia and China in particular is on the verge of becoming a major worldwide powerhouse in the biopharma sector. So if you invest today in a Chinese biotechnology company, that's the equivalent of investing in emerging Chinese technology companies 10 to 15 years back. And who wouldn't want to have the opportunity to invest in Tencent, Alibaba, or Baidu 10 years ago? And if you look at the current COVID-19 crisis, that shows you how far China biotechnology has come. China is actually leading the worldwide race for the development of the vaccine. So China is not just simply adopting and copying Western technology; they are actually leading the race in many areas. So how can you be a successful investor in China? Well, we employ really two strategies. Number one, it's to invest in the blue chip leaders. So we want to find which of the Chinese companies has a chance of becoming the Pfizer equivalent in China. So that is one of the key strategies there. So we find the leaders in pharma like Jiangsu Hengrui, or in hospitals like an AI hospital companies, or the leaders in the generic space. But the strategy too there in China is doing crossover investments, so private investments in the last round before they go public, or become a cornerstone investor in the IPOs of those names. And that is especially important for the more emerging Chinese biotechnology companies. And over the past 2 years, we generated $250 million in gains actually from this IPO cornerstone crossover strategy. So that generated 13 points of performance over the past 2 years. The best example for that is CanSino Biologics. That was our best performing stock during the last fiscal year, generating over 320 basis points of performance. We were a cornerstone investor in the IPO. The IPO priced at Hong Kong dollar 22, and it's up already over 10 times. It's trading right now right around 260 Hong Kong dollars. It was a tremendous success for us inside the fund. But there are many, many more names as well, like Burning Rock, a recent Chinese IPO in the United States, AlphaMap, Shanghai Kindly, Hanso, Akiso. These were all names which had important contributions here quite recently.
I mean, one might imagine that being a healthcare company during a pandemic is something of a sweet spot for the trust. And you've just mentioned CanSino Biologics. I know you own Gilead Sciences as well. I mean, has it been a sweet spot, the pandemic, and how has the trust been affected during the coronavirus crisis.
Well, this is correct. Some of these COVID-19 related stocks had tremendous performance here. Best one was Cancino Biologics. We technically bought, actually, during the month of March, we bought Gilead for their new remdesivir drug for the treatment of COVID-19. That was a really good buy. And a number of our longer term holdings were running up very, very fast during this period because of some COVID-19 themes, like, for example, long-term holding Regeneron, Chugai in Japan, and then a lot of the tools and diagnostic names were beneficiaries of the increased testing for COVID-19, and all of those names have been moving up quite a bit. So I think for us inside the fund, especially during the month of March, COVID-19 related names have been real saviors.
Well, I mean, have you been active in the markets during the pandemic? Plenty of stocks falling to much lower levels. I mean, did you take advantage of lower prices during the worst of the March sell-off? And if so, which stocks have you been buying and why?
Well, there have been some tremendous buying opportunities generated during the sell-off. And typical strategy when we see weakness in the market like that, we focus on blue chip stocks which get very, very dislocated. And some of the dislocated names were like some large cap names where we added to, like an AbbVie on the pharma side, or Bristol Myers, a current position where we added to it. In the HMO space, we added to Cigna. We added a hospital company, HCA, during the month of March, and the big profitable eye technology company, Biogen. MedTech space got really dislocated, and there we added to our current position Boston Scientific, and we added tactically Stryker as well. I think another part of the strategy has been to selectively add to some of our favorite smaller cap names, like the current position Natera. We have been buying right during the middle of the crisis. But this was not just buying, we have been doing like a lot of selling as well. We sold a lot of the COVID-19 names. So Cancino, we have been heavily trimming. Regeneron, we have been selling. Chugai, we have been selling. We bought and sold Gilead during this crisis. And with the strength in our first fiscal quarter, so the period March 31st to June 30th, we used some of the strength in the fund to tactically lower our fund leverage and gearing. So we have taken down the gearing from 112% to as low as 95%. So we wanted to have a little bit dry powder here, just in case the market will again get weak here during the later summer months or in the fall. So we have dry powder on the sidelines that in case we get more weakness, we can really put the money to work.
Do you expect more weakness in the? I mean, I don't expect you to have an answer necessarily, but I'm interested to get your view on where we are in terms of a second wave, that type of thing. Is that's what you're referring to? The powder's dry, just in case there is.
Well, it's just simply it's anyone's guess what the market will do, and the market has been really good at surprising, I think, all the market participating with regards to its strength. I think the driver behind the tactical lowering was just simply the strength in our names. We were selling winners, and sometimes when they move very, very dramatically, it's a good time to sell it, and we are trimming back our exposure, and we will just simply take our time here, just in case we get some market weakness. If we don't get market weakness, we will find some other great opportunity, and we will add. Ultimately, in the long term, we will not stay 95% invested. We will be more in the historical ranges of slightly geared, so 110 to 115%.
That's fantastic. Thank you very much, Sven Borho, co-manager of the Worldwide Healthcare Trust.
Thank you so much for having me.